Welcome to our latest Business Compass webinar. This time we're going to be talking about succession planning and in particular employee ownership trusts. My name is Richard Coulthard and I'm a director of Ice and Harrison Solicitors. We've got 20 offices based around Yorkshire. As you can see on our following slide, we have a top 200 firm nationally, top 20 in Yorkshire. Describe ourselves as the most accredited law firm nationally. As a law firm, there's various independent accreditations which we can obtain from our regulator, the SRA, for example, and statistically we have more accreditations than any other firm nationally. So we'd like to think that we know a little bit about what we are talking about. And actually, crucially for today's presentation, we ourselves are 100% employee owned. So we're not just talking about the legal aspects of becoming an EOT, but we can also talk from our own practical experience. But firstly, let's cover off what options a business owner might have if they're thinking about succession planning. I always say to business owners, you really need to be thinking about what your exit looks like, probably 3 to 5 years out from when you are hoping to actually have an exit, because of the time it takes to actually properly prepare your business for an exit, ensuring that you also get the maximum value out of the business. Now, most business owners, when they think about an exit, they think, well, I'm going to sell my business. I'm going to sell it to a competitor or a trade buyer or something like that. And that might be the best route for you. But it's not the only avenue. We act for a lot of family businesses, and their thought process is about passing it down a generation and the practicalities of doing so. Some business owners will think about a management buyout, so they'll have a selection of managers within the business who could buy the business from the owners. In some situations, business owners just go, well, we're going to do a solvent liquidation. We're going to just liquidate the business. We'll extract any excess cash and assets, and that will be it done. Bigger businesses might look at listing. They might look at going onto AIM or stock exchange or what have you. And then employee ownership trusts. So employee ownership trusts actually came in 2014, but their popularity has certainly increased over recent years. I'm not going to cover all of these today. We'll do other webinars at some point to cover off some of the different points that you can see on there. But really the focus today, I just want to cover briefly about trade sale and then briefly about, or in a bit more detail, I should say, about employee ownership trusts in particular. So looking firstly at trade sales. So this is where a business owner will look to sell their business to somebody else in the market. Now, in some situations, of course, you as a business owner might get approached from a competitor or someone who sees you as a desirable acquisition opportunity. In other scenarios, of course, you might decide to list your business for sale through a business broker or corporate finance house or something like that. As a high level overview, there are advantages and disadvantages of going down this route compared with something that involves your existing workforce. Firstly, one of the advantages of a trade sale is you're typically going to be paid a higher proportion of the purchase price, if not all of the purchase price, on completion, and this is less likely to be possible if you're considering something like an employee ownership trust or management buyout. Market conditions, I have to say, dictate that it is relatively unusual at this moment in time that the full amount of a purchase price is paid on completion. The vast majority of deals will always involve an element of deferred payments, in part so the buyer can manage their own risk. But certainly you're much likely to get a higher proportion of the sales price paid on completion. Also, if you've been acquired by a larger organization, that might well see improvements within the business, further opportunities for existing workforce, further opportunities for clients and things like that. There are obviously advantages to that. Some of the disadvantages of a trade sale, Well, it might result in displacement of existing employees and management teams. Are there overlapping employees? Are there the risk of redundancies? There may or may not be, depending on the nature of the sale. Um, Also, is there a lack of incentive for key existing staff? Are they going to get rewarded for staying with the business? The biggest issue ultimately it comes down to the time and expense of finding a buyer and going out to market, and then going through what might be quite a rigorous due diligence process, where a prospective buyer really looks for all the skeletons in the closet and really goes into detail in terms of your business. So it can be a more onerous process of looking at a trade sale. But is often the right avenue for a lot of business owners. What we're going to be talking about today in terms of employee ownership trust, however, offers an alternative solution, which has become increasingly attractive for many business owners over recent years, in part because of some of the tax incentives, which we'll come on to, in part about rewarding existing staff, in part because it avoids the process of trying to find a third party buyer. But that's not to say that an employee ownership trust is right for every business, because it might often not be. And it may well be that you look at a more conventional route through a trade sale or passing the business down the generation or what have you. So that's an overview of some of the pros and cons, I suppose, of trade sales. Again, we will do other webinars and other content regarding this process in a bit more detail. But really, the focus of today, I wanted to talk about employee ownership trusts, which, despite having been in force for over 10 years now, we've only really seen the increase in prevalence probably over the last 4 or 5 years. As I already said, we ourselves have already been through this process, so we're well placed to give you an overview on this. Now, firstly, you can see on the diagram the change around how the structure works. So to begin with, you will have a limited company, and that will be owned by sellers as individuals. There might be a holding company or a group structure. I don't need to worry too much about that. The point being is that you've got individual shareholders who own the ultimate interest and the ultimate value in the company. And those sellers are seeking an exit and they want to realize that value. So the sellers will sell the shares in the company to a trust. The beneficiaries of that trust are the employees of the company. We set up, for various reasons, a trust company, so that the trustee of the trust, it will be a company very much akin to a holding company. There are technical differences, but for simplicity, that would be the easiest way to think about it. And so the trust, via the trust company, will pay out the seller and the value of the business from the profits of the company in the years after a sale. And normally a seller will be paid the excess cash in the business, for example, on completion. It may be possible to finance the transaction in the right circumstances. But the trust company is responsible for ensuring that the seller is paid out the value of the business. But also the trust company is responsible for ultimately running the business for the benefit of the employees, and the employees can share in the profits of the business. The more profitable business, the more the employees can earn. And there are tax incentives in respect of that as well. So there's plenty of benefits which we're going to come on to. So moving on now to some of the key features around employee ownership trusts and why these have become more popular. Firstly, the seller will pay no capital gains tax in respect of the sale, provided they sell at least 51% of the stake in the company. So this could be a significant tax saving for a seller. Currently, up till April 2025, capital gains tax on sales, or accurately business asset disposal relief on the sale of shares, is at 10%, albeit that then increases in April 2025 to 14% and then to 18% in April 2026. And capital gains tax rates above that level are at 24%. So What this means is if you are selling your shares in a business for £1 million, currently the tax saving would be ordinarily £100,000, but that increase will go to 140,000 from April and so on. For larger sales, if you're selling your business for 10 million, let's say, this tax savings can run into the millions of pounds. So there are significant tax benefits for this. Technically, the position regarding capital gains tax is that it's a deferral of capital gains tax and would then cease to be payable subject to various conditions. But I don't want to overcomplicate matters. To all intents and purposes, a seller is able to sell their business and not pay any tax on sale, provided they comply with the statutory provisions around becoming an employee ownership trust. As already mentioned, the seller is ordinarily paid out of the profits of the business for a period of time after completion. That might run on for several years. You can finance these transactions. We've certainly been involved in deals of this nature where the company has taken out commercial finance, or maybe have remortgaged a property, for example, things like that, to help finance the cost of purchasing the shares. It really does depend on the individual circumstances of the business as to what structure is right. Employees, as beneficiaries of the trust, can earn up to £3,600 per annum, absolutely tax-free. That is still subject to national insurance, but there's no tax to pay on that in terms of income tax. Now, that doesn't replace existing salary, so you can't say, well, you've got an employee who earns, let's say, 30,000 a year, and reduce their salary to 27,000 a year to then pay them 3,000 as a profit distribution. That would be tax evasion. You're not allowed to do that. This is essentially outside of their employment. It is almost akin to a dividend. It's not technically a dividend because the employees do not actually own any shares personally. It is a distribution of profits. And you can distribute more than £3,600, but anything that you distribute above that level is subject to income tax. So, for example, Dyson Harrison solicitors last year, we distributed £4,000 to every eligible member of staff, and the first 3,600, of course, being tax-free, and the amount above that is subject to income tax. I'm going to come on to a worked example later on to show you how powerful this is in terms of incentives for staff and staff retention, and helping grow the business. And statistically, employee-owned businesses do outperform their competitors, and there's a load of research into this from the Employee Ownership Association, and I'd encourage you to have a look at our website because there's some great figures on there around this. But not only then does the seller benefit from tax savings and the employees benefit from tax savings, the company itself also benefits from potentially significant tax savings, because any profits distributed to employees are then deductible from the profit within the business. It's an employment expense, and this thereby reduces your corporation tax potentially significantly. So unlike dividends, which are paid to shareholders, which are obviously paid out of the profit after tax, the employee distribution comes out of the profits pre-corporation tax, so you can have some significant savings in that regard. Importantly, sellers can stay on within the business in an employed capacity, so they can continue to run and operate the day-to-day operations of the business, and can also be involved as a trustee, and we'll come on to that in a moment. Also importantly, unlike business asset disposal relief, where there's ordinarily a qualifying period of 2 years to get the benefits for that, a seller to an EOT doesn't have a qualifying period. So subject to certain rules and conditions, you could have not held the shares for the qualifying period that you would normally have to hold them for business asset disposal relief, and yet you would still get the tax benefits of converting to an EOT. These are not straightforward structures. There's going to be a lot to think about, and expert advice is really required from solicitors, from tax advisors, and we could help support you on that. Moving on to some of the frequently asked questions we get around employee ownership trusts, which I've put on screen, and I'm going to run through each of those. One of the biggest questions we get is who ultimately manages the company if it's an EOT, and is it managed by the employees, and there can be a concern about that. To be absolutely clear, the company itself is still ultimately managed by the board of the directors of the trading business. So the employees don't run the business. The trust doesn't run the business. The business can still continue to be managed in exactly the same way as it has always been managed, subject to some caveats. So, as with any company, there are certain decisions which have to be approved by shareholders. Now, typically, for most SME businesses, the directors of the trading business and the shareholders are more often than not one and the same people. So, we don't have to think about that division. There is a change here, of course, in where you become an EOT, because the board of directors won't ordinarily own the shares in, or any shares in the business. The shareholder is the trustee of the trust. And so there's certain decisions which may need to be approved by the trust. For example, the amount of the profit distribution has to be approved by the trust. If the trust wanted to sell the business, that's again something that needs to be approved by the trust. But for the most part, the day-to-day management of the business continues to be operated by the board of the directors of the company. So it's not being run by the employees. The employees might have a greater degree of influence, but they are not decision makers. The next question we quite often get asked is, do employees own the shares? No, they don't. An employee does not directly own any shares in the business. So if an employee leaves, there is nothing to sell. There is no complications around things like bad leavers or trying to recover shares from people who've left the business or anything like that. It is the trust that owns the shares. The beneficiaries of that trust are the employees. So the employees benefit as members of the trust, but if they cease to be employees, they cease to be beneficiaries. And that's a really important point. Moving then nicely on to the next question, what happens if an employee leaves the business? Well, as I've already mentioned, the employee doesn't have anything to sell. There's no lump sum payment to an employee or anything like that, unlike if they actually own shares in the business or anything like that. They just cease to be a beneficiary of the company. How is the profit distribution calculated? Right, there's two strands to this. One is what the profit scheme rules say and how it can be distributed, and secondly is actually the amount of that profit distribution. Dealing with the first point, and that's profit scheme rules. There's only 4 bases on which the profit can be distributed. What this is not is a position where the trustees can pick and choose as to which employees get what. There has to be an objective set of rules around profit distribution, and that needs to be linked to one or more of 4 categories. One, everyone can get the same, so it can be the same fixed amount that everybody gets. 2, can be linked to remuneration, so those who are on higher salaries will get a higher proportion of the profit distribution. 3, it can be linked to hours worked, so those who work more hours get a higher proportion. And 4, it can be linked to length of service, so those who have been with business longer get a higher share than those who are shorter service. And you can do those in combination. You could, for example, do 50% of a profit distribution is fixed, so everyone gets the same for that 50%, and 50% is linked to, let's say, length of service, so you're rewarding those who've been in the business longer. So that's how the profit distribution works. It's important to say at this point that that doesn't replace existing employment-related bonuses. So you could still have people on individual bonus schemes. The profit distribution sits outside of that, but the profit distribution has to follow one of those 4 grounds as to how it's going to be paid out. As for the amount of the distribution, well, that depends on how the business does. The board of directors will make a recommendation to the trust each year, or more frequently if you choose, as to what they believe is affordable for the business to be able to pay out in respect of profit distributions. In exactly the same way that if the board of directors were to make a recommendation to the shareholders about the amount of any dividends, it's the same underlying principle. But any profit distribution has to be approved by the trust. So, the more profit that's available for distribution, the more that then can be declared and then allocated according to the individual scheme rules. Question 5, can the seller still be employed by the company? Yes, absolutely. This is extremely common, that the sellers will still be employed by the business and will be paid a PAYE salary. So they will be paid a market rate salary commensurate to their position within the business. And some thought needs to be given to that. But then moving on to point 6 is, can the sellers still receive dividends? Well, if they sell all of their shares to the trust, then no, they can't get dividends, because dividends are a benefit of owning shares. So if they cease to be a shareholder, they can't receive dividends. Some sellers consider whether they want to keep some of the shares and not sell 100% to the trust. That is certainly an option, albeit more often than not. When you go through the complexities of the sellers holding on to some of the shares, it's more often than not determined that that isn't a benefit, and that in most situations the sellers will sell 100% of the shares to the trust. Sellers can also still receive, broadly speaking, profit-related bonus pay, or some other incentive around increasing the sales or increasing the profit in the business. That is ultimately sits alongside their employment, not related to their shareholding or the shares that they've sold. So you've got a lot of flexibility as to how the sellers are then remunerated after completion. How long does it take sellers to be paid? Well, it depends on the deal. There's no absolute time period. In our experience, in most situations, it's between 5 and 10 years, but that's not an absolute. If you think about it, when a business is valued, in most situations, the underlying, what we call enterprise value, is a multiple of EBITDA, i.e. a multiple of essentially net profit within the business. Now, if you're applying a 4 or 5 times multiple, let's say, to get to that value, well, in theory, what you're saying is you're paying for 4 to 5 years worth of profit, which means it's going to take you at least that long, but probably longer, to pay out that value, bearing in mind allowances for corporation tax and things like that. So typically between 5 to 10 years, but it depends on whether they're raising any finance and things like that. And then 8, how's the sales price agreed? Well, the business has to be independently valued. This is not the seller picking a price and going, that's what I'm selling it for. There has to be an independent valuation done by an accountant, corporate finance specialist, tax advisor, what have you, which independently assesses what the business is worth. And actually, some of the rules around this have been tightened up since the 30th of October 2024, as you will be able to see on the next slide. So there was a consultation around EOTs, which concluded in October 2024, which made some recommendations. We were following these in terms of trust that we were setting up, but there was a concern that some historic EOTs might ultimately have been abusive in terms of the process or the underlying intention of them. So there was some tightening up of some of the rules, and so some of those new rules is some clearer statements about the trustees having to be able to get independent advice on the value of the business, and also about the affordability of the repayments around that. Other new rules provide that the sellers cannot have a majority on the board of trustees. So different to the board of directors of the trading business, this is the board of trustees that sit above the company. The sellers can't have control of that trust, because there needs to be a passing of control. We typically, well, 4 broad types of trustee: founder trustees, so that is the sellers; board trustees, so that is individuals who sit on the board of the trading business, can also be a trustee. Employee trustees, that's someone who's employed within the business but isn't on the board of directors. And independent trustees, so very much similar to a non-exec director, someone who can offer some impartiality, some advice regarding the business. We typically recommend that you have all 4 types, but you don't have to. But crucially, the founders cannot make up a majority on that trust, and that's a really important point to to ensure that you set this up correctly. So we can guide you through all of that, but that is some of the new rules that have come in just to tighten up on some of the points. If HMRC were to look back on an EOT retrospectively, they now have a period of 4 years to go back and potentially charge the tax on the sale if the sale did not comply with the rules. So it is important to get this right. Looking now at management incentives, this is one of the questions that we get asked by sellers: is how do you incentivize the management team to continue to grow the business, continue to run the business, when they're not necessarily shareholders. And there's a few options around this, depending on the circumstances and the nature of the business and what is right for them. The simplest in some ways is you could have a director or management bonus pool whereby you essentially ring fence a certain proportion of the profits in the business, which would only be paid then to the directors or the managers, or however you want to define it. That could be linked to the profit distribution, so you could have a certain amount that goes for profit distribution and a director's bonus pool of an equivalent or similar amount. But this is essentially a form of sort of soft equity for the directors. They don't own any of the shares, but they're directly benefiting from the profit in the business, and that is paid as an employment bonus, so is taxed accordingly, but is a relatively simple way of tying directors or the managers into the success of the business. You can do something like growth shares. So this would be where the managers or certain directors get a certain type of share of growth, what we call a growth share, which doesn't give them right to the existing capital of the business, which is sold to the trust, but actually incentivizes them to grow the business because they can obtain a share of the future value of the business if the business grows beyond the current level. It would also entitle them to things like dividends and whatnot. So that can be an option as well. You can give them what we call an EMI scheme, so that would be an option to acquire shares in the business based on the value of the shares at the point that the sale to the trust goes through, but they would be acquired at a future date when the value presumably would be higher, but at the price which was set when the EOT was enacted. So there's some options there around growth shares and EMI, but they need a bit more thought and a bit of careful planning. In particular, what is the director's options around future sale of those shares and how's that going to be realised in practice? The other option would be to sell a proportion of the shares to the management team at the same time as doing the EOT. So, for example, you could sell 80% of the shares to the trust and 20% of the shares to the management team. Of course, the amount that you sell to the management team is subject to capital gains tax in the usual way, that you don't get the tax-free incentive on that. But it can be a way of the management team thinking about ownership and having a share of that ownership. But again, some thought needs to be given to actually how is the management team going to sell those shares in future, and there needs to be some planning around that. So moving on then to a worked example, and I really put this slide in to show the potential power of this as a mechanism. So this is entirely hypothetical business, and done in part for simplicity of figures, but by way of example, we've taken a company that's making a turnover of £5 million, and let's assume that they're making £1 million profit a year. And let's assume that they have 50 employees and that we're doing a multiple of 3 times profit. So we're going to say it's a sale price of £3 million. To repeat, this is entirely fictitious. We're just doing it for simplicity of this illustration. We're going to assume that nothing at all changes in terms of the business throughout the term that we're talking. So during the period that seller is being paid the deferred payments, and again we've assumed that nothing was paid on completion, which would be unusual, but let's just work on that basis. So from the profit of £1 million, let's say that the seller is paid 500,000, so half the profit over 6 years to get to the £3 million. And let's also assume then that from the remaining 500,000 after the sellers have been paid, that the directors consider that an employee distribution of £100,000 is fair amount. Corporation tax is obviously payable on the profit of £1 million less the employee distribution. So the employee distribution is deductible against the profit, so you're only paying corporation tax on £900,000. Importantly, the sums paid to the sellers are not deductible against corporation tax. So you don't get any relief in respect of that. So you've got to be careful about financial forecasts to make sure that the funds are going to be there to pay this. So on £900,000, you'll be paying corporation tax of £225,000, which means that the business, having paid all of that, in theory, should retain £175,000 for working capital purposes. And assuming, for simplicity, that the profit distribution is on a fixed rate model, so everyone, all 50 employees would share that £100,000 equally, meaning that they each would earn £2,000. Fast forward 6 years, and let's assume that the seller has been paid out in full by this point, and therefore the £500,000 that you were paying to the sellers is no longer due and payable. Well, in theory, if the trustees and the directors feel it is appropriate, that £500,000 that you were paying to the sellers could be distributed to the employees. And assuming nothing else has changed, so we're still going to have a profit of £1 million. Well, the employee distribution is then increased to £600,000, which means that you're only paying corporation tax then on the £400,000 remaining profit, which reduces the corporation tax liability to £100,000. So having paid the employees £600,000 and corporation tax of £100,000 means that the company is actually then retaining £300,000 of working capital, which is significantly higher than the previous example, but also means that the employees individually would be getting a profit share of £12,000. The amount above 3,600 would be taxable as income tax, of course. But you can see from that very simplistic example the power of this model to save significant sums of tax in terms of corporation tax, but also a significant incentive for the employees moving forward. Just looking then now at comparisons between an EOT and a management buyout, because often sellers will look at the two side by side, okay? And there are different reasons to do each. An EOT benefits everybody ultimately, but maybe less attractive to the managers who are going to be running the business. So there potentially is a trade-off, albeit for the reason I just said, there might be incentives that you can put in place which enable the managers to feel like they can drive the business forward. Now, the other key difference, of course, is that a management buyout is subject to capital gains tax in the same ways that you would have any other sale, which means that if you've got, you're going to qualify for business asset disposal relief, currently 10% on the first £1 million up to April 2025, but then increasing to 14% and then 18% thereafter. And obviously normal capital gains tax rate above £1 million per seller. The difficulty sometimes with management buyouts is the entirety of the tax on the sale is payable within the first year of the sale itself. So unless the business can afford to pay a large amount on completion, it may well be that a good chunk, if not all, of any completion payment ultimately ends up going to the taxman if you're having to pay the full amount of the capital gains tax for the entire value of the sale in that first year. That's obviously not a difficulty for EOTs because there's no tax on that. So that needs to be considered. Where management buyouts are probably more appropriate is I mean, firstly, of course, if you can fund the deal or we can get a larger payment on completion, from excess cash, for example, then the tax position might be mitigated because you're getting more on completion, but also where you've got key staff members, and there was really an expectation that those staff members would have an equity stake in the business at some point in the future, and there's a risk of losing those staff members if that doesn't come to fruition. Certainly, if you look at a conventional sort of law firm type model, or maybe even accountancy type model, historically, a lot of people went into those professions with an expectation of becoming sort of quote unquote an equity partner or similar. So that was always a thing. Having said that, there might well be a shift in perspective on this, and we've seen and we are advising on a lot more law firm conversions into this type of structure. So it might be less of an issue than it has been historically, but it's still a factor. And again, expert advice should be taken on this. Now, as already mentioned, we ourselves are 100% employee owned. So just moving now to a bit on our experience, we've been through this process and it's been hugely successful for us. So we converted December 2021, so just over 3 years ago now. And I was a part of those discussions and that process. And we had 3 sellers, 3 founders, and 5 of us, myself included, came in as part of the directors to help run the business and drive the business forward. Now, when we converted, from recollection, I think we were about 14-15 million pound turnover. We've grown to just over 27 million pounds in that 3-year period. It's been a astronomical growth, and being employee owned has certainly been a big part of that. It's not the sole reason, but it's a big part of that, because attracting good staff to us, retaining staff, that's obviously so much easier. There's a real differentiator, but also our employees are directly benefiting from the success of the business. It helps them improve things like client care, cost saving, all of this, because they can see the direct benefit of this. But to get the most out of being an EOT, staff communication, staff engagement is absolutely key. They need to feel part of this process. I would also say choosing the right director and the right trustees are absolutely key. Getting the right people who've got to align with your values and are going to help drive the business forward. I think the independent trustee is also a really important role, because they can give impartial advice and perspective on the business. If you choose a business advisor or experienced accountant or someone who's got experience in your sector, they can really impart knowledge which will help you really drive the business forward. Very much akin, as I said, to a non-exec director, which would be perhaps more common in bigger businesses, but actually you're getting that benefit there. You also need to recognise the importance of, as I've termed it, your drivers, people who are going to push the business forward, and make sure that they're incentivized, whether that's through bonus schemes or whether that's through share options or however you do it. You need to make sure that they are correctly rewarded to stay with the business. Deciding the distribution model, that's really important. We went for a fixed rate, so everyone in our firm gets the same, and that was done after fairly lengthy discussions on the basis of everyone benefits equally. We're all in it together, but that might not be right for everyone. That needs some careful thought. And finally, the 80-20 rule. And what I mean by this is you're always going to have someone offside. You're never going to get every member of staff on board with this or any other process. Whether it's a trade sale, whether it's a management buyout, whether it's an EOT, you're always going to have a minority of people who are maybe questioning motives or reasons for doing this, or don't agree. The key is making sure that you've got that engagement, and that 80% are really the ones that are going to help win the business over, drive the business forward for the long term, and have that incentive to do so. But overall, we found it to be an absolute success for us, and was the right decision for us. But that's not to say that it's the right decision for everyone. And what I would say is, if your motive for looking at EOT as solely tax driven, then it might not be right for you. The tax savings are clearly hugely beneficial, but actually you need to look at the wider picture for you and whether it is right for your business. But we're here to help. We're doing a lot of advice work on this, and so that if you want a consultation, you want to understand a little bit more, we can talk you through it. This has been very high level today. Similarly, if you need advice regarding succession planning generally, then we're here to help and would be delighted to help guide you through that process. Um, that's it from me here today. I hope you found this insightful and informative. Um, as said, if you are in need of any advice or support regarding succession planning, whether that's a trade sale, management buyout, family business, or an EOT, we're here to help. Our team are vastly experienced in advising on these matters, and we've helped many businesses through this process. Thank you once again for listening here today, and hope to see you here next time on our Business Compass webinars and podcasts. Thank you very much.